Hey, Richard.
Hi, Dan.
So you just recently wrote about intellectual capital, intellectual capital versus physical capital, and the evolution of that, going all the way back to the days of the Egyptian pharaohs.
Fair enough. Yeah.
So tell us about that. What was that all about?
Okay. We have to understand capital develops together. Intellectual capital develops physical capital develops intellectual capital, but the driver is what happens between our ears.
Okay.
So, in the time of the pharaohs, if you were an ordinary person or you were a slave, you had very simple tools. You had a hammer, you had perhaps an inclined plane, maybe even a pulley. But that was about it, and it didn't change for another several thousand years. However, if you were the pharaoh, your tools were the slaves, and you got to use them and their work. And that led to some difficulties about intellectual capital. Nobody likes being bossed around, or very few. So go a long way. A guy building a cathedral in England in 1500 would have had roughly the same tools as the guy building the pyramids for the pharaoh. And not much had changed. There wasn't much development, there wasn't much savings, there wasn't much improvement. But a couple hundred years later, they developed a steam engine. And that changed what people could do, the scope of what they could do. And there wasn't just the steam engine, but a lot of other things. But with steel rails and the railroad and steel mills, now there's a whole lot more physical capital, and there's a whole lot more demand on the intellectual capital of the people involved. How do you use those tools? In the 1870s in the United States, steel was a big deal, and making steel was a big deal. It was the largest industry we had, made rails to put railroads across the country and so forth. The standard shift was 2 12-hour days, two shifts per day for 12 hours each. That was dangerous. You get really tired in the hot environment. And like the pharaoh, the owner of the plant really didn't pay much attention to who you were and what things were like. Along came a guy who worked for Andrew Carnegie, and he determined that 3 shifts of 8 hours was much better. It was safer. People aren't going to worry about falling into boiling steel. They're going to work more efficiently. And for sure, he paid them the same amount per shift, so that's a 50% increase in labor costs, and got even greater productivity.
Oh, wow.
So it's really clear. You don't need just the machines. You don't need just the ability to work the machines. You also need the culture that surrounds you, the worker, so that you do your best, you do your safest, you trust where you are. Those are very important elements.
Right.
And it's still a lesson that not everybody's learned. It isn't obvious. Treating your employees well will get greater productivity out of those employees and will allow them to use their intellectual capital to a greater degree. So steel mills, relative to what can be done with chemistry and electronics and so on, looks fairly primitive today. You're essentially cooking a bunch of elements together and coming up with a product. Today, human beings are making machines that create AI.
Okay.
That's a whole new kind of intellectual capital. And the companies, then the organizations striving to do something with AI have essentially equivalent machinery.
Okay.
They've got computers, they can write software. But some of that machinery is really well advanced. Where does that great advance come from? It comes from the intellectual capital of the people designing the circuits that create it. So the circuit designers at NVIDIA have done a superlative job of speeding up the actions of the electronic circuits that they produce and sell to their customers. Why do they do that? How have they been that much successful? One thing for sure is Jensen Huang must be one heck of a motivator. They can't have so much success without people striving for it. The employees are well paid, they're well equipped, and they're well motivated. As he says, we're not interested in doing something that everybody can do. We're interested in doing something hard. And doing something hard has got to be really satisfying for an engineer. We're making something others can't make. It's a great feeling. So that's the kind of interaction between culture and intellectual capability and the bedrock physical capital that everybody has.
Right. I mean, we now live in a world, and this has been happening for a long time now. And, you also went into, I know in the note, because I read it, you talked about how for like the longest time, the value of capital didn't really change much until, but if you look at the last, call it century, the value of intellectual capital has grown much faster relative to the value of physical capital.
Because it can get more out of the physical capital we have. The guy who runs Adobe said, all of our capability lies in the minds of our employees.
Right.
And that's the way it is with this kind of capital. If you were manufacturing a drug, you need very specialized equipment. So you and I can know a great deal about drugs, but we can't operate without that physical capability. But the intellectual capability that creates the aha moments that make things really work comes from the employees' head. So what do you have to do if you're running the business? You can't be like the Pharaoh. You can't say, I don't really care whether they come to work or not. I don't really care whether they're happy at work. All of the very big, major, successful technological companies have marvelous places to work.
Yeah.
They're not just having sushi because they think it's a nice thing to do. They're providing wonderful amenities for the people who come to work so that they will be motivated to come to work. They will not be distracted by stuff they want to do. Oh, you've got some dry cleaning. Well, we'll take care of that. You don't need to stop on your way to the office.
Yeah.
We'll make sure that the business environment you are in is one that's helpful to you, stimulates you, challenges you.
Yeah.
Those are the kinds of things that make a great culture.
Right. I mean, this is kind of a crude way to put it, but back when physical capital really was all there was, or it was the majority of the capital in the business, you really took care of that physical capital well, right? You maintain it, you were careful not to damage it. But in a world where, you're using intellectual capital to basically create value in the business, you have to take care of the source of that intellectual capital.
Yes.
Right. And therefore, what you're seeing is more and more companies essentially paying greater attention to and providing an environment, or providing the kinds of environments where the sources of that intellectual capital would be, happy and engaged and be thriving.
Exactly. The CEO of Cummins Engine in the early 1950s at a board meeting spoke up. And he said, I've had the feeling that Cummins is in Indiana. Think hogs, lots of hogs. He said, I've been thinking about the way we treat our employees. we treat our hogs better than we treat our employees.
Mm-hmm.
We probably ought to stop doing that.
Yeah.
Cummins' competitive advantage is in the workforce and its know-how and its ability to machine products and to do things with their brains
Yeah.
and the physical capital that is much greater. So I imagine they actually took some real time to stop treating their employees like animals and treating them more like people and encouraging them.
Right.
It's got to be a big help. And whatever it is, Cummins has been a very successful company for 100 years.
I mean, and we see in the market that intellectual capital is valued more highly than physical capital.
Mm-hmm.
You just look at price to book multiples.
Yep.
Companies with high intellectual capital content, software companies, right, for instance, trade at much higher price to book value versus a high physical capital content company and low intellectual capital content company, which seems to make sense because a unit of intellectual capital is much more scalable than a unit of physical capital. So it makes a lot of sense that a unit of intellectual capital would be valued more highly than a unit of physical capital.
Absolutely. You can do more with the brains of the employees than you can do with the equipment that they have. They'll figure out new things to do. When Warren Buffett bought Berkshire Hathaway, he thought he was getting a great deal because he could buy it below book value. He could buy it for less than the physical capital was worth, or, was on the books for.
Sure.
When he tried to sell it into a dying business, that capital really wasn't worth much. And he had to take a very big discount, i.e. down to scrap, in order to sell the physical capital. So the physical capital without the intellectual capital doesn't work very well. So you want to employ people, incent them to take that capital and make great things out of it.
Yeah. I mean, intellectual capital, as nice as it is, also is kind of a double-edged sword, right? Like, it's something that you can't just replicate overnight.
Nope.
Brand, for example, intangible capital.
Yeah.
Brand, you can't recreate overnight, but at the same time, if you don't take good care of it, it could also disappear. Like, there's no, at least with machinery, to your example, there's some salvage value to sort of a failed physical good, if you will, a piece of machinery. But there's no salvage value to a failed brand or a failed line of code, software, or
What you want is the utility of the interaction of the physical capital and in some cases intangible capital that you build up. The easiest kind of intangible capital to describe is brands. Take two brands, one successful, one a disaster. Coca-Cola is a successful brand. They are really, really, really tough on themselves to make sure that they advertise their product in all sorts of happy events. So you'll see them on the back of a magazine at Christmas. You'll see them at sporting events. You'll see them at all kinds of things that make people happy. There was a time when Eastman Kodak ran things, had a brilliant brand. Two things happened. One, they acquired a competitor. How did they acquire a competitor? The competitor was Fujifilm. And one year, Gillette, which had been doing what Coca-Cola does and has continued to do, said, the Olympics are too expensive. We'll take a pass.
Yeah.
They'd been at every baseball game. They'd been at football games. Every time people were happy, there they were. Then they said no. Well, Fujifilm bought that time and went from being a small annoyance to being a real competitor. Now, intangible capital can't carry you everywhere, as we know from the development of digital cameras. Kodak had invented digital cameras. The technology was theirs, but they didn't figure out how to apply it. Apple and others did, and Kodak's history.
Right, right.
So you need both, and you need to be very careful about how you apply your intangible capital and how you take care of the physical capital.
Yeah. How do you mitigate the risk of intangible capital going away, losing its value?
Well, you keep spending. I mean, it's not cheap. You can't just simply say, I'm Coca-Cola, and expect people will remember you year in, year out, unless you stimulate that memory, and you stimulate it with pleasant memories so that people think, a Coca-Cola is a pleasant thing to have. It's really, really, really powerful.
Right.
Gillette has been at men's sporting events since there have been men's sporting events on radio and television.
Yeah.
And they do not give up their time, their sponsorship, even under Procter & Gamble, change of ownership. They know that this is something that they have to continue to build.
Right.
Number of years ago, many years ago now, Perrier was the only water. It seems hard to believe today. You can go into a restaurant, a bar, and you got a choice of things, of water. Used to be it was only Perrier. Then they had some trouble with their bottling plant, and they decided to put carbon dioxide instead of the natural effervescence in the bottle. Word got out, oh my gosh, it's not bottled at the source as it once was. It's bottled just like anything else. And so it's overnight stopped being special. You can now, if you look hard, find Perrier. It used to be you had to look hard to find something else.
Right.
That's what you can do to intangible capital if you don't take care of it properly.
Right. I mean, as an investor, though, from the outside, right, and we don't, investors in public markets, you don't really, you don't control the business. So the best, what we do, as you know, is we focus on the culture of the company, and we rely on the culture of the company to be the steward of that
brand.
Intellectual capital, whether it's brand or it's, whether it's the, happy and engaged, energized workforce, the engineers that write the software, because there's only so much we can do, and to ensure that intellectual capital not only continues to be productive, but also builds and compounds.
And grows, yes.
Right?
Think of Hermes. So run by a family, a couple 100 people in the family, but only a few actually run the business. And they're very careful. Every generation learns how to make a saddle stitch. Now, to be an executive at Hermes, do you have to know how to make a saddle stitch? Probably not. But what you do need to do is show respect to the guy who does do the saddle stitch. That person will continue to be doing his work when he says, the boss even cares about what I do.
Right.
I'm prominent. I'm important here. Additionally, somebody asked the CEO within the last couple of years about acquisitions. Shouldn't you be buying something?
Yeah.
And he said, no, we only know how to run Hermes. We don't know how to run something else. So
Yeah.
we'll keep what we're doing. And so they've introduced some products over time. They now sell lipstick.
Yeah.
And they didn't 10 years ago, but they're very, very careful about what they do. So you have the intellectual capital, the skills of the artisans who make what Hermes sells, and the stitches are perfect.
Yeah.
And the management wants to make sure the people doing that work know that they are prized.
Right.
They are, and they're praised. They don't fool around with things they don't do well. They change very slowly. They add products very slowly. And then it's all based on the intellectual capital of the designers.
Right.
The colors they choose, and the shapes and the jewelry and all of the things that they make come from the brains of a bunch of people who are really thinking all the time about this.
Right.
And they, in turn, are respecting the artisans, and the managers are trying to run the business as carefully as possible.
Right. Yeah, I mean, I think, we tend to favor companies that are focused, because just like you said, not focused for the sake of focus, but when a company is sort of focused and is pretty narrow in its scope of not trying to do too many things, it also tends to lead to sort of cultures, or it tends to take away some of the risk factors in diluting or changing the culture.
Some of the
for
distractions.
The worse, right?
Yeah.
You mentioned slow moving in the context of Hermes.
Mm-hmm.
We've been spending some time on sort of investment opportunities in sort of slower moving industries, right?
Mm-hmm.
So bringing this idea into the current sort of environment and the investing context, when we think of intellectual capital, most people think of, like, as we've been discussing, brands or software, things of that nature. But actually, we've been finding some interesting opportunities in industries where you traditionally don't really think about it being a high intellectual capital content businesses. And obviously we're not top down in our approach, and we're simply always looking for the most attractive risk reward opportunities. And lately we've been finding attractive risk rewards in slower moving, slower changing, sort of a more mundane, if you will, even industries, where by being better than your competition, even though it's not highly branded or very heavy in software content type of business, you can really differentiate yourself.
We just spent some time on Old Dominion Freight Lines,
Right.
which is a trucking company. It's a less than truckload trucking company. Less than truckload means that each customer doesn't have enough to fill a truck, so you put different customers' stuff together and deliver it. National network, really important to be on time. And of course, it's really important to not damage the goods.
Yeah.
So Old Dominion uses intellectual capital in several ways. Of course, there's the physical capital. You've got to have the trucks. You've got to have the warehouses. You've got to move freight through things. Very physical business.
Mm-hmm.
But intellectually, they have to know their costs. When you tender a shipment to them, they're going to charge a price where they make a profit. If I were put in charge of Old Dominion tomorrow, I wouldn't have a clue as to what that price is.
Mm-hmm.
But over the life of the business, they have studied it, and they know what it costs to move something.
Right.
And to move it from here to there, through this warehouse, through that route. Really powerful. And they have the discipline, which is another form of intellectual capital, to not cut the price just to move some freight.
Right.
1. 2, their employees are cross-trained. So the long-haul drivers who take loads from one warehouse to another, sometimes all the way across the country, those guys also know how to work in the warehouse and move stuff when there's a crunch, and they can help out.
Mm-hmm.
And so they can move things around the entire facility so that they maintain being on time. Additionally, the same people who are trained to drive long haul are trained to do pickup and delivery. Again, if there's a bottleneck, if there's something needs to be done that needs somebody to pitch in right now, they've got those people. The result is, the numbers are staggering, just amazing. they damage less than 0.1% of their shipments. The average trucking company, less than truckload trucking company, it's almost 2%, 1.9 something.
Yeah.
20 times
Yeah.
more damage with the other guys. They're on time 99+% of the time. In the industry, it's about 94, I think.
Right.
All of that comes from people using their brains as well as the equipment in an informed way to run the business smoothly, carefully, and they're incented. They're paid for safety records, which are really important. They're paid for no damage. They're respected people, and the management knows who they are and back and forth. And so their turnover is much lower. So the people, and that feeds on itself. The longer you are in a job, the better you know the job.
Mm-hmm.
It's just true of everybody.
Right.
But it's even truer there. So it's a whole package of physical capital. They got to have the trucks and the network of warehouses. Some intangible capital, their reputation, their discipline, which you can't touch, not to accept poorly priced loads, and their intellectual capital. I know this job, and I know this job, and I know that job, and I can put them together to make the business work.
Right. Right.
We don't know if this is going to be a great stock or a poor stock yet, but it certainly has the ingredients of doing well.
Right. Because for them, it's not, like you said, it's not that they have, better trucks. It's not that they have, better terminals necessarily. I mean, they might, the geographic, footprint or the distribution or the density, those things, I'm sure were thought out well, and therefore may give them some advantage. But ultimately, what sets them apart is how they manage the business.
Yeah.
And their ability to price the service properly, and the willingness to the discipline to actually walk away from business that doesn't pay enough.
Yeah.
And so you're right. As much as when we talk about intellectual capital, we at least for me, the thing that we think about the most are, for example, like there's a talent war going on in AI right now. Apparently, making headlines, paying some incredible sums to try to lure away the best and the brightest AI engineers because,
because they know
what is the AI race all about? At the end of the day, intellectual capital, right? But not in a similar. It's sort of the scale is different and the context is different, but for Old Dominion and for some of these other companies in more sort of slow changing and even mundane kind of industries, the terms of the competition definitely is about intellectual capital as well, just in a different.
Well, at least one of their competitors
context.
knows that because they recently hired the chief operating officer away for a bunch of money.
Right.
To make him have him come to their business and make it better.
Right.
This is the kind of thing, though, that's built up over time, and it won't be the change of one person to change the entire business.
Yeah, I'd be interested to see how this all plays out. But just because as you said, just because you hire somebody away from competitors, like I can think to years ago, or I guess a couple of decades ago, a lot of Wall Street firms, for example, would try to hire from like the best firms.
Yep.
Hire somebody from Goldman Sachs to come run our trading business or our investment banking department, to try to be more like them.
Right.
But often it's way more than just one person. It really is.
It's a whole system.
It's a whole culture of the company.
Yep.
The whole system.
Yep.
So we'll see if hiring from Old Dominion will turn its competitors into something better. But often it's more than just one person.
That's a lot of things.
Yeah. I mean, this also kind of gets me thinking about businesses that are in sort of more higher physical capital content industries. As an investor, just like how as an investor for companies with high intellectual capital content businesses, we have to figure out a way to make sure, or I don't know if make sure is the right word, but reduce the risk that the company will damage the intellectual capital. We have to, find a way to make sure that the companies will not destroy and put to the highest, most productive use their physical capital. And in that sense, if you think about it, whether it's intellectual capital or physical capital, somebody needs to allocate that to the best and most sort of highest, most productive use. And at the end of the day, who allocates capital, period, whether it's physical or intellectual, it's humans.
Yes.
And the organization that runs that business, which is why, for us, it comes back to the culture.
Well,
companies with the right cultures will allocate capital well, whether it's physical or intellectual.
Well, remember I told you about the Carnegie steel mill, where the manager had put in a system where they were going to have 3 shifts instead of 2. People would be better rested, be better able to do their job. It didn't last. Andrew Carnegie came home from a trip. The manager was away, and Carnegie said, "We're going to have 2 shifts like we used to because it's a lot cheaper." Meaning the pay was cheaper, was less. The net pay was nowhere near as less, and the productivity went down. And the feature of an 8-hour day became more and more important. It took another couple of decades to get it nationwide, but it's become a standard because it's safer and therefore more productive. So even somebody like Andrew Carnegie, who made an enormous amount of money, wasn't always insightful about every bit of his business.
When we try to think about pursuing intellectual capital as an investment strategy, I know most people will be thinking about, especially today, about technology, for example, where it's really about the differentiation in intellectual capital. But as an investor, we also have to think about price and what is expected in the price. And of course, trucking or industrial rental, equipment rental, or maybe even things like pharmaceutical as an industry, or business software like the mature kind, not the hot,
not the brand new
kind,
stuff.
Not the brand new kind. They're not growing nearly as fast as sort of the hottest parts of technology today. But those are often also markets where you don't have 90% market share, 80% market share. Like, in technology and software technology, very often you find, winner take all, if not winner take most type of dynamics where the number one really has the dominant share. In areas like trucking or industrial equipment or just sort of mature business software, you don't really have that. But as an investment proposition, it's still interesting and attractive, because I think right now a lot of these companies' expectations, one, are way lower than what's expected for the fastest growing, hottest technology companies. And even though the industry may only be growing 2%, 3%, because these are far more fragmented,
they can take share.
They have a lot of room to take share. And taking share in these industries means that you're doing something better than the competition. And kind of going back to trucking, if you're doing something better than the competition, that means that you're using your intellectual capital to deliver better services, lower losses, more better on-time delivery and properly charging for that. So you could have plenty of growth even in these industries that are slower changing if you really know how to use your intellectual capital well. Add on top of that, the stocks in these industries, the level of expectations
is lower.
built into the stock price is nothing like what's being expected in really, really fast-growing, hottest parts of the market. So that's why we find it interesting and find ourselves allocating capital incrementally more to that area. But obviously we're not negative on technology. It's a big part of our portfolio still. But when we think about where do we want to put that incremental capital towards, we've been seeing more opportunities, actually more attractive risk-reward opportunities, I should say, in these sort of slower moving type of industries.
We don't need Old Dominion to grow faster than NVIDIA.
Right.
We just need Old Dominion to grow faster than its competitors. Every year, bit by bit, higher returns on incremental capital. That'll be plenty.
Yeah.
We'll do fine with that.
Yeah.
If they continue to do what they have been doing.
Right.
Please do keep doing what you've been doing.
Right. Shifting gears a bit, speaking of looking for investment opportunities currently in the market, sort of the general environment of the market. We're not top down, but there are things that we sort of observe and see and hear and pay attention to. And since our last conversation a month ago, markets are the U.S. S&P's
up nicely,
5% or so. Technology is up a little more. Prices are all back. When we last spoke, actually, prices hadn't S&P 500 anyway hadn't come back all the way to the previous high, but now it's surpassed that. Multiples also therefore have come back. It doesn't feel like we've been feeling like it's not. We don't know obviously what's going to happen to the market, but it doesn't really feel like the kind of an environment or sort of the time to be at least really aggressive in terms of risk taking.
Caution is a good thing, generally speaking. There are times when you might not want to be cautious, but generally speaking, you get a warning about those times. Those times are when you and everybody else is scared to death. It's kind of the inverse of the way you feel. Ben Graham wrote about Mr. Market, and Mr. Market was manic, and he was your partner. He would sell you more of what you and he owned, or he would buy from you at whatever the current price is. And some days the current price is he's really optimistic. And some days he's really pessimistic. And what you have to do, and it's hard, it's probably as hard as learning the skills involved in analysis and all of the other information gathering things, is to be fearful when others are greedy and greedy when others are fearful. Thank you, Warren Buffett. It's really well put that way. But you want to be, when others are afraid, that's the time you need to get your courage up. And when others are really optimistic, you want to be kind of skeptical. And that's where we are. We're kind of skeptical. I don't think we're scared to death or whatnot, but it's the markets appears to be prosperous and we're kind of skeptical.
Yeah. The thing is, when I express skepticism or the various ways in which things could potentially go wrong, one of the pushbacks I get is, a bull market climbs a wall of worry.
Yeah.
Right. And I agree with that. We've seen other cycles coming out of downturns, and yes, that is true. my then pushback to that is that adage is used to really describe an environment of generally low expectations, right? Because people are worried and perhaps fear is widespread, and maybe fear is too strong a word, but concern is widespread. Expectations are pretty low, and therefore market, when expectations are low and prices are climbing, it's climbing a wall of worry as it goes from pessimism and fear to feeling better and better into euphoria. But right now, I mean,
as a general rule, walls of worry are not constructed on the tops of all-time high prices. And that's where we are. So yeah, you can worry about the market, but that's not really what we mean. It's worrying about the conditions. Oh my gosh, I'm going to just lose everything because X is going to happen or Y is going to happen. That's the time to be courageous.
Right.
Not the time when, oh, everybody's optimistic. I'll be optimistic too. I'll be even more optimistic than them.
Right.
If you can adjust your thinking so that you are largely contrarian to what the general view is, you'll do better than going along with the crowd.
Right. Right.
And I have to say, that's not easy.
Right. And when I look at, various indicators and just look at, say, PE of the market, it's high, but it's not like extremely high.
Yeah.
Right. But at the same time, we're hearing of, and I realize that this is anecdote, and I'm always going to overweight data over anecdotes. But when you see some of these behaviors in the market, and when I ask myself, is appetite for risk high or low right now? It's probably on the higher end than on the lower end.
Yeah.
For example, we're reading about, SPACs are back.
Yes.
Right.
Yeah.
They're nowhere near the level that we saw back during the SPAC boom of 2021. But so far, year to date, the number of SPAC IPOs and the amounts raised by SPAC IPOs already in the first half of the year already is more than all of last year combined. For example, we're reading about the return of the meme stocks.
Yeah.
Right. So it used to be GameStop and AMC and the likes, and this time we'll see how long it lasts. Maybe it's just a very temporary thing. But names like Kohl's and Krispy Kreme donuts and
Kohl's went up because they're going to buy Bitcoin. Was that what it was?
No, I think it was actually no. It was sort of the similar to the GameStop situation.
Oh, okay.
It was a heavily shorted stock, and so the buyers were kind of trying to squeeze the shorts out of it, and so it shot up like triple digits at one point.
Yeah.
But to that point, I mean, there were also these companies that are simply announcing that they're going to become a Bitcoin or crypto treasury companies.
Right.
Their stocks go up a lot. Now, one could argue that maybe some of these companies are really legitimate and there's a real strategy behind it. Whatever one's view is about that. When you start having copycats, and just because you have a particular structure, you're being rewarded with a massive premium. Those sorts of anecdotes kind of keep me kind of alarmed.
Yeah. The market is full of very imaginative, creative people, and if people like pink stuffed toys, and the price of pink stuffed toys is going way up, they'll make more pink stuffed toys.
Yeah.
They'll make so many more pink stuffed toys, you'll wish you never saw another pink stuffed toy because the price went to nothing.
Yeah.
But in the interim, people can look really smart and so forth. The investment business is not that. It's not betting on the price of a particular thing.
Mm.
The investment business is getting a return for what you pay. And if you pay a fair enough price, a low enough price, and the business functions well, over time you're going to earn what the business earns. And that's a good thing.
Yeah.
And the more careful you are about the selection and the better price you get, the better you're going to do. Unfortunately, the world spends its time mostly in the middle.
Yeah.
So that it is not overpriced or underpriced. The bargains are not real cheap anywhere you go. You have to keep at it. You have to keep studying it. And finding something new is always A, fun, and B, difficult.
Right. And just to be clear, I'm not saying, certainly not definitively in any way, that just because we're seeing some of these sort of pockets of speculative activity and therefore headlines,
Yep.
news headlines, that, oh, the market's dangerously priced. There's a lot of speculation. There's speculative spirit is kind of, back and has overtaken the market. That's not what I'm suggesting at all. But while we pay greater attention to sort of broad level, indicators and health gauges of sort of market health and level of expectations, some of these stories, at some point, one of the lessons from, I guess, the 2021, 2022 period was sometimes when you're observing too broadly, almost always, like, these things will get missed.
Yeah.
Because in the greater scheme of things, they're never like dominant, right? But there are sort of these are symptoms, if you will, that you could monitor. That if you're only taking a very broad approach, it's not going to be visible.
Yep.
It's like throwing a stone in a big lake, but underneath it, and when you look at it more deeply, these things happen, and sometimes it could be a precursor to some of the things that are kind of brewing and developing.
One of the things that it strikes me is that we do this every day. This is what we do for a living, and it's fun, and it's interesting. It's absorbing work. Sometimes it's really frustrating, and sometimes it's really difficult, but it's generally speaking rewarding, and it's a great thing to do, and we do a lot of different things. For the person who is doing this work for themselves, it's really, and has another job, has another line of work, it's really important to pretty much stay with that line of work, because that's something you know really well. And you have an advantage over people like us, because our line of work is really broad. Yours can be really special. And you might uncover and understand a business much better than we will, and find that there's a real discrepancy between its value and its price. And you want to buy it and hold it for a long time and understand it and keep after it. That's a very good thing for an individual investor to do. Use the knowledge you develop to live your life, to live your business life to advantage. And that's a good thing. That's a good thing.
Yeah. And what we always come back to, we'll spend investment team meetings talking about some of these macro things and observations and what's going on in the world and how it might impact, the markets, this, one way or another. We ultimately always come back to making sure that we're constantly looking for opportunities where expectations are, somewhat, expectations are low.
Right.
Obviously, timing the market is really, really difficult. If not, some might argue it's impossible to do it, at least on a consistent basis. But if we're constantly looking for and investing and going after opportunities where expectations are fairly low, then and you have the sort of the time and the patience to wait until expectations change, which may happen soon or take a long time. But if that's what you consistently pursue over and over time, that ought to lead to pretty good investment results.
Yep. The original Berkshire Hathaway finally went out of business as a men's suit liner cloth manufacturer. That's what they did. And suits went out of fashion some, and the business got competition from overseas, and it got crushed. So that can happen.
Yeah.
But more importantly, if you're in the business, you're going to know whether your business is under serious pressure, fatal pressure, and be able to find good investments inside your business. However, doing what we do is really kind of fun too, because we get to learn a lot about things that we otherwise wouldn't know anything about.
From our standpoint, and for those that may want to invest not only in the industries that they work in, but more broadly speaking, investing in leaning into sort of low expectation situations is not comfortable. Generally speaking, how you get low expectations, you get low expectations in the price if the stock hasn't been performing well.
Yep.
And almost always, if not always, stocks don't perform well because there's an obvious reason for concern. Therefore, in order to invest into low expectation situations, you're gonna run into basically problems, if you will. So and kind of investing blindly into low expectation situations is probably not a good idea, and certainly it won't feel you won't get any comfort doing so. But if you can do it with a competitively advantaged business run by an organization that has a really effective culture, and if you then pair that with low expectations because everyone thinks you're not going to make it, or everyone thinks that the best days are behind you for whatever reason, if you can really pursue those opportunities, again, via companies that are competitively advantaged and run by
Smart
organizations with highly effective cultures, then that obviously we think is a worthwhile pursuit.
That should do you very well.
Okay. All right. Well, on that note, thank you.
Thank you.
See you next time.
Yep.